So since last time we met, we were talking about the budgeting chapter, chapter 9, and we had gone through direct labor, direct management, budgets, production budget, a number of different budgets, purchases budget, and we left off at the manufacturing overhead budget. So the manufacturing overhead budget is the one where we include all of the costs which are related to manufacturing, but not traceable directly to the product. So our manufacturing overhead budget, we have some data. At the company we're looking at, Royal, the overhead is applied to units of product on the basis of direct labor hours. So each direct labor hour gets charged $20, and the fixed manufacturing overhead is $50,000 per month. Includes $20,000 of non-cash costs, primarily depreciation. The reason they're telling us that is because those are not actually expended in cash, so they don't require cash budgeting. The purchase of the assets in the past was when we spent the cash. The depreciation is just an accounting allocation of the cost between periods, or inter-period allocation of the cost. So the manufacturing overhead budget looks like this. We have the budgeted direct labor hours taken directly from the direct labor budget, and the animation is not working. How do I make the animation work? That's an interesting question. Just a second. Okay, let's pick up from there then. The direct labor budget shows us the direct labor hours, the rate that we apply through the variable manufacturing overhead rate that we've talked about would be the $20. So we multiply that out to get 26, 46, and 29 for a total manufacturing variable cost of $101,000. Then we add the fixed manufacturing cost of $50,000 per month, and then the non-cash costs are deducted. So depreciation, not being a cash cost, doesn't actually enter into our cash budget. So we add those back, or remove them from the total manufacturing overhead cost that we have to pay in cash. And that gives us the cash disbursements for manufacturing overhead, which is what we need to actually have in our cash budget. So then the next step is to look at the ending finished goods inventory budget. So the direct materials cost us £5 at 40 cents, or $2 per item, for a standard cost of the direct materials in each unit of productivity, or each production rather. Direct labor was 0.05 hours at $10 an hour, so 50 cents per unit. On our manufacturing overhead, we took the total manufacturing overhead for the quarter of $251,000 and divided by the total labor hours of 5,050. It works out to $49.70 per hour. We apply that to 0.05 hours because it's on the basis of direct labor hours that we allocate our manufacturing overhead. The production costs are $4.99. So we take a look at our ending inventory. We want 5,000 units, and that's taken directly from the production budget. We calculated that earlier. So the ending finished goods inventory for our balance sheet purposes, our budgeted balance sheet would show ending finished goods inventory of 24,950. Then the selling and admin expense budget. Once again, this is basically a prediction in advance of the cost of selling and administration expenses, non-manufacturing expenses, so therefore they're not added to the cost of goods sold or the cost of goods in inventory. So the selling and admin expenses have some variable portions and some fixed portions, as we expect at this point. So variable selling and admin expenses, 50 cents per unit sold, not produced but sold. Fixed selling and admin expenses are $70,000 per month, including $10,000 of depreciation, which once again are not cash. So our budgeted sales, taken from the sales budget at the very beginning of this whole chapter, 20,000 in April times 0.5, or 50 cents per unit of sales, gives us variable expenses of 10,000. We have fixed expenses of 70, deduct the non-cash expenses, leaving us with 70,000 of total cash S&A expenses. So the quick check, we always were kind of expecting one of those. What are the total cash disbursements for selling and admin expenses for the quarter? We need the sales items, so let's see, it works out to 230,000. Let's see how we calculate that. I suppose I should have let you go back to the sales budget in your PowerPoints and calculate it. But 230,000 is calculated as follows. We've got budgeted sales of 20, 50, and 30 in the 3 months in the quarter, and 50 cents each. Add 70,000 each period for fixed expenses and subtract 10,000 non-cash expenses in each of them. Works out to $230,000. In future, for the quick quizzes, I suppose you could pause the video lecture here and go back to your PowerPoint presentation and fill in the necessary information, and you could check to see whether you're right, which would be useful. Pretty hard to do that without the interactive in-class portion of our PowerPoint presentations. Anyway, the cash budget is next step. We've figured out how much we're going to collect from sales. We've figured out how much we're going to pay for purchases. We've got a bunch of other cash costs for manufacturing overhead and for the selling and admin expenses. So we have a lot of information that talks about cash flows during the period, and so that's the next step. We have to put it all together. So we start with the cash receipts and cash disbursements, ignoring borrowing. We'll have to work with the borrowing assumptions as we need them. So cash disbursements would be all of the payments except for the payments on borrowing. So principal and interest would be excluded from our cash disbursements in their first part. So we start with cash receipts, then cash disbursements as we figure them out. We determine the excess or deficiency, and that will have implications for the timing of borrowing and repayment of our borrowing. So the cash budget, key things to build in as assumptions. There's a 16% interest on the open line of credit, so they can borrow up to $75,000 and they have to pay 16% interest on that money. They want to maintain a minimum cash balance of $30,000 so that they have cash to pay their bills as they become due. They always borrow on the first day of the month, which requires them to have a good idea of what the cash budget actually is. And then they repay the loans on the last day of the month. That just helps us to assume the interest cost in a fairly low cost way, so we can actually determine using full months as opposed to days the amount of interest we have to pay. And we don't have to make assumptions about the flow of cash flows during the period or anything like that. They plan to pay a cash dividend of $49,000 in April. They're going to purchase $143,000 of equipment in May and another $48,000 in June, and both of those purchases are paid in cash. So depreciation is added back, but we do deduct the cost of equipment that's actually purchased. The April 1st cash balance, the opening balance, is $40,000. And let's see if we can pull all of the information together into a cash budget now. So we start with $40,000 of opening cash. We have cash collections, which comes from our cash collections budget or cash collections schedule. Next, we have cash disbursements for materials, which comes from the purchases analysis we did earlier, and we call that the schedule of expected cash disbursements. Direct labor, we've budgeted for that. It's $15,000. Our manufacturing overhead comes from the manufacturing overhead budget. The selling and administrative budget, which we just finished, $70,000, and then we have a dividend in April. So that gives us a net overdraft, I guess, or a net outflow of cash, a deficiency of cash. That's the word I'm looking for. It says right there on the screen. $210,000 coming in, $230,000 going out. That leaves us with $20,000, and of course the $210,000 includes the beginning cash balance, so that means we're actually in a negative position in our bank account. We're in an overdraft position. So that means we have to borrow enough to maintain our minimum cash balance of $30,000. So we're in a negative position, 20. We add 50,000, and that gives us an ending cash balance of 30,000. And then we just run this through for the next 3 months. In May, we have all of the information from the budgets that we've had in the past. We're collecting a lot of money this period, so $400,000 in collections. The materials budget is high in anticipation of the busy season over the summer months, and we have the equipment purchase of $143,700, and that leaves us with a $30,000 excess in this case. So that meets our ending cash balance requirements. I'm just wondering about the interest on the borrowing, because presumably, well, no, I guess we still have the $50,000 outstanding. So with the $50,000 in place, our opening balance is $30,000. You can see down at the bottom here, the 30,000 ending cash balance gets carried forward to the beginning cash balance of the next period. So we're good, but we don't have any excess to actually pay off our borrowing in June. So then we do one more month. Well, here you go, your quick check. Go back and check to see if you can calculate the excess or deficiency of cash available over disbursements from June. And so you're going to fill in all of those pieces. The 30,000 from the bottom, the ending cash balance, will be carried forward to the beginning cash balance of June, and then you add your cash collections from the schedule of cash collections, the cash disbursements for materials purchases, direct labor, all the other budgets, and we also had an equipment purchase in June. So build all of that in and determine whether there's an excess or deficiency. I'll let you do that, and then when you come back, I'll be moving along. So what is the excess deficiency of cash available over disbursements for June? Turns out we've got lots of cash, $95,000 extra cash generated this month. So of course we can pay back our loan, and we can pay the interest because we've had a $50,000 loan, which we took out at the beginning of April. We paid it back at the end of June. So that's 3 months out of the total 12. 16% is our interest rate, which is a fairly aggressive interest, fairly significant interest rate for a line of credit. So perhaps we're in a service-oriented business and there's not lots of equipment that they can use as security. Hard to say, but for some reason that's a fairly high interest rate. $2,000 is the amount of interest. So the ending balance is going to be $43,000. We can also see the quarterly result starts with the opening balance from April and ends with the closing balance at the end of June. And so all of the total cash collections and total costs are listed there. And so we end up with a position of $43,000. Now note, if you were a banker looking at this, you could see that we need to borrow money at the beginning because we actually have a negative position. But given our plans, we have plenty of cash to pay it off within 3 months. You wouldn't see this as a particularly risky loan if you were lending the money. Of course, we have the line of credit, which would be previously established in this case. So the bank would presumably have already analyzed our ability to pay and had allowed us a line of credit that we could take advantage of up to a total of $75,000. So all we did is just use that. In this case, we didn't have to have a separate contract or a new contract to set up the borrowing. Now finally, we have the budgeted financial statements. So we can actually prepare a budgeted income statement, a budgeted balance sheet. If our bonus, for example, was based on the income as well as, say, share price, which is fairly common, we could budget our income statement and determine whether or not we were going to qualify for a bonus. If not, we could make adjustments to see if we could get ourselves into the bonus position. Anyway, that's the information for all of these pieces of the income statement all show up as part of our analysis. The sales budget for the 3 months, the quarter ended June, is a total of 100,000 units at $10. We calculate the cost of goods sold using the ending finished goods inventory budget. We actually calculate the cost of all of the pieces of inventory, and we know that we've sold 100,000 of the units, and their average cost is $4.99. Then we have the gross margin. The selling and admin expenses comes directly from the selling and admin budget. Of course, not the cash amount, but the total expense amount, including the non-cash depreciation charges. And then our interest expenses, $2,000 from the cash budget, and that gives us net income of $239,000. We can also prepare a balance sheet. A few other things we need to know to fill in all of the information, none of which is affected by the production this period. So 50,000 land presumably doesn't change with production. Common shares, retained earnings, the opening number is 146,150, and the equipment is 175. Excuse me. All right, that was the patient asking for some help. So hope you didn't miss me too much during my time away. So we have some information that we're going to put on our balance sheet right here, and so the balance sheet is going to be filled out. With land, we have $50,000. These are the opening balances, presumably from the last period's balance sheet. We had common shares of 200,000. Our opening retained earnings was 146,150, and our opening amount of equipment was 175. Of course, with the retained earnings, we're going to add the income, the budgeted income statement, minus the dividend that we received, that we paid out, and the 175,000 of equipment is going to be supplemented by the 2 purchases of equipment we did according to the cash budget. All right, then moving along, our balance sheet just looks like this. We have the cash budget ending balance of 43,000, right, shown right there. The accounts receivable comes from the sales budget and the cash receipts budget, I suppose it was, the schedule of cash receipts. And we have raw materials inventory, which constitute 11,500 pounds at 40 cents per pound. The finished goods inventory had its own little budget, so that was 5,000 units at an average cost of $4.99 each. The land is simply the amount of land we had at the beginning. We didn't have any transactions in land. Equipment is the opening balance plus the 2 purchases we made in May and June. That adds up to our total property equipment number and our total asset number 564. Accounts payable comes from the purchases budget, and so it was $28,400. You can go back and check if you want, but it's 50% of the June purchase of $56,800 haven't been paid yet. The common shares didn't change. Retained earnings, we will see in the next slide, is the beginning balance of 146 plus the income of 239 minus the dividend that we paid according to the cash budget, giving us an ending balance of 336,150. And as accountants, we're happy that the balance sheet actually balances. That's great. So the budget that we just went over are static budgets. What does that mean? Well, that means that we picked a planned level of activity, essentially the amount of sales we were planning for, and on the basis of the sales, we predicted what the costs would be. Now that's fine as long as we actually do the level of activity we planned for. But what happens if there's actually a different level of activity? The actual level of activity is not the same as our static budgeted level of activity. Well, we can prepare something called a flexible budget. And a flexible budget is where we apply the cost structure, the variable and fixed costs, and we adjust the amount of the static budget to incorporate the actual level of activity. So a lot of the variance from the static budget to our actual experience would be due to simply to the fact that the volume of activity was different. And so if we can explain that through a recasting of the budget to the budget we would have predicted had we known in advance the actual level of activity, then we can identify the variances from the budget which were not due simply to that activity level difference, but were due to management choices. So how does that work? Well, our static budget was based on 10,000 machine hours. Turns out that we have actual results of 8,000. Now, for a quick introduction to the idea of flexible budgeting, if we have 8,000 machine hours, and our indirect labor, for example, our indirect labor is $40,000 for 10,000 machine hours, and those are supposed to be related to the number of machine hours because they're variable costs. That means we would expect to have $4 per machine hour as the variable cost if we only had 8,000 machine hours of activity. 8 times 4 is 32. The actual amount is 34,000. We also notice there's a slight difference for the indirect materials and the power from what we would expect based on the variable cost per unit. Here, the variable cost per machine hour. We also have some depreciation numbers and insurance numbers which represent our fixed costs. Depreciation is just an accounting calculation, so we wouldn't expect to have any variance there, but insurance we actually have to pay somebody outside the organization, so we paid an extra $50, more than we were expecting, and it's fixed cost, so it shouldn't change. So we calculate the variances as the next step. There are some unfavorable variances and some favorable variances. The amount of machine hours we worked is unfavorable because that means we're doing less work, we're being less productive. So it's unfavorable in the sense that it will result in a lower level of productivity or profitability. We also see some favorable variances in the variable costs, and they're fairly substantial. But we have, as we have calculated, if we look just at indirect labor, we expect indirect labor to be $32,000, but it's $34,000. The $32,000 would be our expectations just on the basis of the difference in the activity level. So we actually have a $2,000 unexplained variance and an $8,000 favorable explained variance. So the 2,000 is actually an unfavorable variance. So if we're looking at drawing inferences about our good or bad management from this measure, we have a 6,000 favorable variance, which really isn't favorable. All we did was do less work, and it looks like we're spending less money. But we should have spent less money because we did less work. So the question we're needing to answer is how much of that variance is actually due to the volume of activity, and how much of it is actually attributable to good or bad management practices. We can see that overall we have a fairly significant favorable variance, but most of it is because we didn't do very much work. All right, so let's see if there's a way we could fix that. Since cost variances are favorable, have we done a good job controlling costs? Well, not really. And so we need to figure out what it would have looked like, what the budget would have looked like if we had known in advance that we were only doing 8,000 machine hours of work. So we know that variable costs change in proportion to the activity level, fixed costs don't, so we should be able to prepare a flexible budget, given that we understand the nature of the costs. So if we have 8,000 hours, we know that we've calculated the indirect labor cost was $40,000 for 10 hours, and so that works out to $4 an hour. Our indirect material cost should be $3 per hour. Our power cost should be 50 cents per hour for a total variable cost of $7.50. The fixed cost shouldn't change. So they should be the same no matter what volume of activity we do. So we can use that to prepare the flexible budget. And here we are. The budget should be for 8,000 hours of activity, 32,000, 24,000, and 4,000 respectively, just applying the variable cost per unit per hour to the number of hours we actually worked. The fixed cost shouldn't change, so our budget should have been 74,000. If we had known in advance, we wouldn't have budgeted for 10,000 hours, we would have budgeted for 8,000 hours, and we would have budgeted 74,000 as our total overhead costs. That was the budget for 10,000 hours. It was wrong because we didn't actually do 10,000 hours of work. We could even cast a flexible budget for 12,000 hours. So if we did extra work, we could estimate what the cost would be there. So I'll let you take a look at what the total overhead cost for the flexible budget would be at 12,000 hours. I don't think you need any other information other than this one, so push pause if you like and do the calculation to determine what the flexible budget would say for 12,000 hours. Works out to $104,000, which is probably what you got when you did the calculation yourself. So congratulations on getting the correct answer, if indeed you did. The total overhead cost would be $14,000 plus 14,000 is the fixed cost, plus $7.50 per hour times 12,000 hours for a total of $104,000. Looks just like that. Now, we could actually calculate variances based on the flexible budget, and we see they give us quite different results. The flexible budget at the activity level would be exactly the same as the actual because the actual was used to determine it, so we wouldn't have a variance there any longer. The question the quick check is asking now, what is the variance for indirect labor when the flexible budget for 8,000 hours is compared to the actual results? I think we determined already that it was 2,000 unfavorable, but you should check that. So once again, given the information, the 34,000 is the actual results. I'm not sure if I can get you that information. There we go. So it's $4 per hour indirect labor, and the correct or the actual result is 34,000. Calculate the variance and determine whether it's unfavorable or favorable. I think you'll find it's 2,000 unfavorable because we spent more than we should have spent for that volume of activity. For indirect material, once again, $3 is the indirect material cost. Multiply that by 8,000 to figure out what the flexible budget was. Compare that to the actual results and determine whether there's a favorable or unfavorable variance. I'll let you pause and then start again when you've got the number calculated. The correct answer is 1,500 unfavorable, which is probably what you got. So congratulations once again if you did indeed get the correct answer. We can fill out the rest of the table as shown. We should have spent 24,000 on indirect material. We spent more than that, 1,500, so it's unfavorable. We spent a little less on power. than we would have expected. So that's a 200 cost savings, which is favorable. The overall variance is quite different from the picture that we saw compared to the static budget. In this case, we can see that there's quite an unfavorable variance when we factor in the volume of activity. So the volume of activity explains most of the variance and leaves the rest as unfavorable after adjusting for it. So the question from earlier, how much of that 11,650 favorable variance is due to lower activity? Woo! Turns out that 11,650 of the favorable variance. No, that was just a recalculation of the favorable variance from here. If we look at it again from the perspective of a flexible variance, we see that 15,000 of the variance is due to the difference in the volume of activity, because we compare the static overhead budget to the flexible budget with the correct number of hours. So 15,000 was due just to lower activity. If we had known in advance that 8,000 hours would be our budgeted level of activity, we would have come up with $74,000 as the estimated or predicted total manufacturing overhead costs. Turns out that it actually costs us $77,350, which is unfavorable. If you take 15,000 favorable minus 3350 unfavorable, that gives you back your 11,650 favorable variance overall. Finally, we're going to talk about not-for-profit organizations briefly. Not-for-profit organizations are kind of the reverse of profit-oriented businesses. For profit-oriented businesses, we start with revenue recognition and we match all the expenses to the revenues. With not-for-profit organizations, we usually start off with an idea of what it is we want to do. We determine what the costs of doing that would be, and then we go out and try to collect it from our donors and members. And so it's kind of the reverse process. So we're actually matching the revenues to the expenses, which we determined we needed to expend in order to do our not-for-profit objective, whatever that might be. So budgeting is a little trickier with not-for-profit organizations. All right, inventory, I don't think we cover this in the course, so we'll stop there, and that'll be enough for today. You get a little bit of a bonus because we can't do in-class problems since we're not in class. So let's pause there for a moment. All right, I've taken a look at the slides, and I think it's probably worthwhile for us to go through them. Essentially, it's kind of a quick discussion of the issues around inventory, which have been sort of assumed to be fairly constant in our discussion of production. And so there are some things that you would need to add to your thinking if you're actually in an inventory management position. And so some of those things are included in the following slides. So the question is, how does the manger know? It's actually the manager. I think there's a missing A down here in the manager, because the manger, of course, is where they keep the hay in a stall in Bethlehem. So that's not really what we're talking about here. So how do we determine what the optimal level of inventory is? We just assumed, as we were given the budget information, we assumed that the appropriate level of inventory for this period depended on the amount of inventory necessary for production or sales the next period. And the question is, how do we actually come up with that decision? Well, it turns out that the decision is usually a balancing of costs between the order costs and the carrying costs. So there are certain costs which are associated with ordering new inventory, and so transportation costs certainly comes to mind, sort of the freight in discussion we've had in the past. Also, there are costs of accounting for ordering. The more times you have to reorder material, the more times you're going to have to pay for the whole process of having one of your clerks take care of it. So that's the clerical costs they're talking about. But on the other hand, if you have a larger order and you keep it in your own warehouse, there are costs associated with having to store that inventory. So those carrying costs would include the cost of interest on any funds you borrowed to buy the inventory, the cost of having rental space or a building space available to it. So that would include property taxes, cost of your mortgage interest, insurance on the inventory, all those sorts of things. So there are kind of those couple of different kinds of costs. The larger your orders, the more your ordering costs and the less your carrying costs. The smaller your orders, the smaller number of orders, but the larger size of orders would imply higher carrying costs and less ordering costs. There are also some shortage costs, and those are the costs of not having enough inventory. That would include the cost of customers unhappy because they weren't able to get everything they were looking for. You might lose sales to your competitors because you don't have inventory in stock. There could be discounts that you're losing because you're not purchasing in high enough volume. You may have production holdups or bottlenecks because you don't have adequate amount of inventory. So there are a number of costs that are associated with just having insufficient or shortage of inventory. We can use a technique called the economic order quantity to calculate that. If you decide that you're going to take what's the name of the course? We actually have a course in the business curriculum that talks about a number of these issues, queuing theory and economic order quantity and those sorts of things. It's been taught by Joy Monsma. It's not coming to mind. But you can actually take a course that talks about these things if you want to take them in more detail. Business 371, the corporate finance, the intermediate corporate finance course, we do talk somewhat about the economic order quantity and inventory management as part of that course as well. So there's a couple of different approaches to calculating the economic order quantity. One is using a formula based on the cost of ordering versus the cost of having shortage. So cost of ordering versus carrying costs, so ordering costs versus carrying costs. The shortage costs are a little harder to quantify, so it's really hard to determine what the lost sales are. It's hard to build those into a formula, but you can balance the cost of ordering versus the cost of carrying inventory. A couple of other things to think about. Production lot size. You want to set your inventory purchases based on the amount of units you usually produce or you usually require for your standard lot size. So your batch of production may be a consistent amount, and so in that case you want to minimize the amount of times you have to reset the manufacturing process to set it up for different sizes or different kinds of inventory that you're producing. So you would include that lot size in your analysis, as well as the cost of carrying the excess inventory, to make sure that you minimize your setup costs. So you can actually balance your setup costs versus the carrying costs in this case. And so that would tell you your economic reorder point. And the economic reorder point is when your inventory gets down below a certain level, you replenish it. So that there's apparently some typo problems going on here, because the order must be placed, not laced, to replenish depleted inventory. All right, so we've got a few missing letters in this last couple of slides. So the idea of the economic reorder point is determined in order to make sure that you have adequate stock to fulfill your normal economic lot size of production. Lead time is the amount of time you want to order in advance, so you make sure that it's actually received at the time you need it. So if you're doing just-in-time production, the lead time would probably be less, but you'd be paying more for that, because you're putting your supplier on notice that when you order stuff, he better get it there quickly, or you may be looking at a different supplier, those sorts of things, right? So lead time is the amount of time it takes to get stuff delivered after you have determined you need to place an order. A safety stock would be additional inventory that you have just in case you need it. So the safety stock gives you a margin of safety so that you don't run out and have to shut down your production line while you're waiting for the supplier to ship you that information. And that's all there is to this chapter. So we will be picking up the in-class problems on next class. Thanks for listening. Goodbye.